Dr. C K Narayan is with us. Thanks very much, sir. Good morning. Good to have you with us here. So it certainly gives you a sense that the market is essentially heading lower, slow grinding, but it's heading lower. Is that a fair way to look at it?
Well, I think that may be a little severe way of putting it, because what have you really done? If you look at it in terms of the recent movements, you have moved up from 75.50 to about 83.50, and you have paid about 200 points from that high. So that's not really going down, isn't it? So we are just having a kind of normal reaction. We went up about 700-800 points. We are down about 200 points. I think the market is just resting, and it is resting because there are no specific inputs right now. I think to a good extent, maybe the market had already priced in the lack of expectations of Q2 results, right? So wherever there is some bit of surprise, that is being pushed up, or where there is deep disappointment, that is being pushed down. Otherwise, most of the stocks are lying around flat, whether they are average results or slightly subpar results. The global markets seem to be a little quiet. Inputs from across the globe seem to be rather limited. We seem to be waiting for Bihar elections. Not that it is such a big event, but then in the absence of any other news or event right now, the market needs to focus on something. And right now it's going to be Bihar. So I think we'll probably see markets start moving a little more once the exit poll thing starts moving from, I think, 5th evening onwards. So that is where you should see some larger movements. Right now the market is just drifting aimlessly.
I think that fundamentals, the argument is endless. Markets, one can be a bit more precise, but there are various ways to argue it out depending on one's position in the market itself. But it was especially the L&T results which kind of has dampened sentiment overall. Largest, most diversified infrastructure company, and just very, very poor results and outlook. Outlook more than the performance itself for the second quarter. Pharma, IT, nothing exciting as far as results are concerned. So, no real reasons for the market to go higher, except, of course, global liquidity, etc.
Yep, I would actually tend to agree with that, and it's in line with the point I mentioned earlier that the market had already priced in a lack of expectations from Q2 results, right? And you just enumerated the same across a wide variety of sectors. So you're right in saying that there is absolutely no trigger for the market to go up. But the key thing in the market is that it needs some amount of selling for it to go down, right? Otherwise, profit taking just leads to some bit of drift in the trends, not really an aggressive decline. So right now, just like you said that there is no reason for it to go up, there really doesn't seem to be any reason for it to go down. I don't believe that, if you take the, let's say the average of about 1,000 results declared so far, I think the average is indicating that there is a slight improvement in profitability. There is the sales are more or less a little bit flat, but, at the PAT level, at the interest level, everywhere, there seems to be a little bit of improvement. So the market doesn't have a reason to go down also. On the corporate front, politically, I think the situation will be clarified once we do hit the next week, when the Bihar thing will be a little more clearer, and then we have lots of things to look forward to for the next session. That could go either way, but the Parliament session is something that the market will look at. So right now, for the next quarter as a whole, there isn't really any major news to take the market up or take the market down as things stand right now. So markets will actually respond to developments along the way across the next quarter, rather than build on something which has been there already.
Yeah. I think one can reasonably make the case that there are triggers for the market to head lower. Right, it was this, and this is not about just India as well. Around the world, the constant fight is corporate earnings being slow, not picking up, global growth deteriorating quite a bit. At the same time, markets staying higher and even doing better. I mean, take US as an example. So, you know, and the big divergence, I think it's a big, and if you're handling a large, very, institutional money, very large sums of it, it really becomes a problem. Because if the benchmark keeps going higher and you underperform, then it gets unpleasant. But here in India, earnings are clearly the driver, which I think can force the market steeply lower. You know, we are looking at 4-5% growth now, I think, for the full year, fiscal 16, which means that 17 growth will, in both in absolute and relative terms, will look that much lower, which means valuations will look higher. The index P will look a lot higher.
See, what you're saying is, quite logical in terms of the various arguments that you laid out. But let's look at it from the market's point of view, right? For whatever reasons, the market doesn't seem to be buying that, So clearly, maybe it's not looking at 16 numbers or even 17 numbers, and maybe it's sort of still has its hopes pinned up on this entire Modi rally, and is probably looking out into the future. Now, let me just give you an example. I had similar thoughts a while ago, and I sort of decided to take a look at whether there is exits happening from overpriced stocks. So I went over all the stocks which are, priced at about, let's say, more than 40 times earnings, and I made a huge list of it, and I looked at the charts of all of them and tried to study the volume patterns across them. And to my complete surprise, I found that there was virtually no exit from any of them. Now, if we were to take your argument that yes, there is only about 4 to 5% growth ahead of us, clearly fund managers who are sitting on a large pile of stocks and also looking at similar numbers should be the first people who should be worried about that, right? And they should be taking steps to probably get out of more expensive stocks. The very fact that there is no selling which is evident among all these so-called higher price stocks or higher valued stocks clearly indicates two things. One is that either they are not worried about these high valuations, or they are seeing growth further down the line, maybe not 16 or 17, but perhaps 18, 19, 20. I mean, maybe people are taking a more distant view on these stocks. At the same time, the inflow of money into the, let's say, domestic mutual funds certainly does not seem to be waning. And here the perspective seems to be that if you have visibility for about, let's say, 2 to 3 years in terms of earnings and growth, then they just pile into it. If you study the movement of various charts of, let's say, the mid-cap stocks, one thing which emerges out of this is that wherever there is earnings visibility across the next 2 to 3 years, the market is not giving you a second chance to buy that stock cheaper. People are just wading into them, and then they get into these strong hands who are unwilling to let go because they are not looking at a 1 year, 2 year time frame, and it's very clear they are looking further down the line. So absence of liquidity, great demand for good stocks, unwillingness to sell, no very overt triggers along the line, maybe some fairly, let's say, average type of growth and earnings ahead, and then there is a hope for the best. I think all these are cumulatively leading to a situation where there is an absence of selling. There is also no, let's say, gung-ho buying, so we are not having that aggressive upward move, but definitely an absence of selling means that people are, I don't think the market will really head down by any large yardstick.
All right, fair enough. We'll leave it there, Dr. Narayan. Thank you very much. Great speaking with you. Appreciate you joining in with that perspective. Thanks indeed.
Thank you.